Xiaomi is better known as a phone maker, but now it's about to start deliveries of its first electric vehicles. The Chinese firm says customers will get its initial SU7 sedans later this month. It says it now has 59 stores in 29 cities nationwide ready to take orders. A price for the vehicle will be revealed at a launch event later in March.
Competition, disruption, and outlook. What we're seeing right now with NIO and other Chinese EV stocks is a surge, all thanks to Xiaomi jumping into the EV game. Xiaomi's announcement of a new electric vehicle has lit a fire under the market, pushing stocks like NIO to new heights. As one of China's leading EV players, NIO's position in this competitive market is crucial. But with Xiaomi shaking things up, how will NIO fare against this new competition?
NIO has yet to become profitable, unlike its rivals like Li Auto, even XPeng, targeting 2025 to become profitable. What about the unveiling of new vehicles?
News about Xiaomi's entry into the electric vehicle market has sparked a surge in Chinese EV stocks. Xiaomi, known for its consumer electronics, including smartphones, is set to launch a new EV on March 28th. This announcement comes amidst a price war in China's EV market, with automakers slashing prices to stay competitive. While the price war has created uncertainty, Xiaomi's move has boosted confidence among Chinese EV producers, with NIO experiencing notable gains. However, despite the positive momentum, questions linger about whether this signals a turnaround for the Chinese EV market. While Xiaomi's innovation is promising, the ongoing price war presents challenges. Now, even though NIO stock saw some ups and downs after the announcement, it's holding steady in positive territory and is continuing its impressive growth over the past week. But it's not just NIO enjoying the ride. Other Chinese EV stocks are also thriving. For instance, BYD Company and Li Auto have seen over 5% and 7.5% gains, respectively. Meanwhile, Xiaomi stock, listed as XIAOMI, has been on a steady climb throughout the day, currently boasting a more than 10% increase. The company is gearing up to launch its new four-door SU7 EV sedan, signaling a significant turning point for Xiaomi. Reports suggest that this EV might outperform Tesla's in terms of acceleration time. Xiaomi's CEO, Lei Jun, has ambitious plans, aiming to position the company among the world's top 5 automakers. With a pledge of $10 billion investment in car production over a decade, Xiaomi has earned approval from the Chinese government to enter the EV market. The SU7 will be manufactured by BAIC Group, a state-owned automaker with the capacity to build 200,000 EVs annually. If the SU7 launch successfully drives quick sales, Xiaomi could emerge as a formidable rival to Tesla soon. Despite being new to the EV manufacturing scene, Xiaomi's track record in producing electronic devices speaks to its capability. Recognizing EVs as the next frontier of technology, Xiaomi is poised to significantly impact the automotive industry.
First of all, I think NIO is in a very hyper-competitive market here in China. Obviously, there is a bid, and there's typically a pullback in the beginning of the year. When you enter a new calendar year, as the year-end numbers tend to be inflated a bit as dealers close. But even with that, given how competitive the market is, they've had to take down pricing in the second half of last year in order to achieve the growth that they were able to in the third and fourth quarter as they launch new products.
Now, let's analyze the popularity of Shanghai-based electric vehicle maker NIO among U.S. investors. NIO stands out as one of the most heavily traded Chinese stocks, boasting average trading volumes surpassing 56 million. Initially dubbed as the Tesla of China, NIO has garnered significant attention. However, despite its initial hype, the company is currently grappling with ongoing losses and lackluster delivery figures. Investors are left questioning the outlook for NIO stock and whether the Chinese EV giant can live up to its earlier acclaim. Looking back, NIO stock reached its peak in February 2021, hitting an all-time high closing price of $62.84. At that time, its market cap soared to over $100 billion, reflecting the vitality surrounding startup EV companies. Comparable players like Rivian and Lucid Group also commanded lofty valuations during this period. For instance, Rivian's market cap surged to over $150 billion shortly after its 2021 IPO, while Lucid Group's market cap approached $100 billion at its peak.
But it's going to be a very challenging market for all EV makers, including NIO, with the pricing conditions in order to sustain the volumes that they've been able to achieve in the second half of last year. And I think going into this year, we're seeing weakness in demand. which is going to plague the industry going forward, and it's going to continue to put pressure on pricing.
Unfortunately, some challenges have dampened the once exuberant growth of the EV industry, particularly in 2022. The Federal Reserve's aggressive rate hike campaign that year marked the end of the easy money era, which had been crucial for many startups in the green energy sector to sustain their operations. This abrupt change in financial conditions significantly impacted companies with high cash burn rates, including those in the EV space. Specifically, the demand for electric cars failed to meet automakers' expectations, resulting in overflowing inventories at dealer lots. For NIO, these challenges were exacerbated by the derating of Chinese stocks amid the country's economic slowdown and strained relations with the Western world. As a result, NIO stock has experienced a downward trend, with losses recorded every year since its remarkable 1,100% rally in 2020. Looking ahead to 2024, the outlook remains grim for NIO, with the company already witnessing a significant decline in its market capitalization. These industry-wide pressures underscore the EV sector's formidable obstacles, necessitating strategic adaptations to navigate the turbulent market landscape. But before we move on, we just want to thank you for watching this far. What about NIO's recent performance? Well, it's been a bit disappointing. In the first 2 months of 2024, NIO only managed to deliver 18,187 vehicles, and even factoring in the Lunar New Year holidays in China, the numbers don't look too promising. The company's growth seems to be slowing down, with revenues rising by just 6.5% in Q4. Looking ahead to Q1 2024, the guidance suggests only a marginal revenue increase at best, with a potential year-over-year decline. Analyst Eunice Lee from Bernstein pointed out that NIO's market share in the Chinese EV market has plummeted to around 2%, a significant drop from 5% in early 2021. Despite expanding its range of models, NIO is struggling to maintain its market share. But it's not all bad news for NIO. There are some silver linings amidst the gloom. For instance, the company's vehicle margin improved to 11.9% in Q4 2023, up from 6.8% in the same quarter the previous year. NIO anticipates further margin improvement to between 15% to 18% starting in Q2, aiming to eventually reach its long-term goal of 20%. Crucially, NIO ended 2023 with a healthy cash reserve of $8.1 billion, including cash, restricted cash, and investments. This financial stability sets NIO apart from many other startup EV companies facing bankruptcy due to dwindling cash reserves. As for Wall Street, their recent sentiments toward NIO have been notably bearish, contrasting with the company's recent positive performance. This has led to a stark division among analysts regarding the firm's 12-month prospects. Out of 12 experts surveyed on the stock analysis platform TipRanks, 5 rate NIO stock as a buy, 1 as a sell, and the remaining 6 maintain neutrality. Despite NIO's relatively stable average rating, the 12-month price targets have seen a noticeable decline. For instance, the highest projected price as of March 12th, set by Citigroup, is 40 cents lower than the average target on February 2nd at $10.40. Additionally, the average price at press time stands at $7.02, implying a potential 15.68% increase in NIO stock, while the lowest target, provided by JP Morgan, suggests a further 21.31% decrease to $4.80. Analyzing NIO's technical analysis, the outlook varies depending on the time frame used. While the monthly chart indicates a buy signal by oscillators, the moving averages signal a strong sell. However, the short-term analysis shows a more positive outlook, with NIO being rated as a buy across the board. Examining NIO's recent performance, there are indications of improvement. Over the last 30 days, the stock has risen by 0.99%, and the last full week saw an impressive surge of 14.13%. However, despite these short-term gains, NIO shares remain significantly down both year-to-date and in the last 52 weeks, with the stock price standing at 37.98% below its initial public offering price. Considering the competitive landscape in the Chinese EV market, the anticipation surrounding Xiaomi's upcoming launch of the SU7 EV sedan adds an interesting dimension. If successful, the SU7 could pose a challenge to NIO and other EV companies, potentially making it more difficult for less stable players to compete in the crowded market. This raises concerns about NIO's future prospects amidst increasing competition. So, which EV giant do you think will emerge victorious in this competitive race? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about NIO stock, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.